Let's see. Hey guys, welcome in. Welcome to the channel. Welcome to Smart Money Bro on YouTube and in other places. All right. We're in other places. So just want to welcome you guys in and say hey to you. What are we going to be talking about here? What are we going to be talking about tonight on this stream? It's ETFs and index funds, guys, and why most people lose at investing because they skip out on index funds and ETFs. If you ever felt sort of late to the party, sort of confused or stressed about investing, tonight is going to help explain to you why, what's going on, and how to fix it. By the end of this live today, guys, you're going to clearly have a solid, clear understanding of what index funds are, what ETFs are, and what the real difference between the two really is. All right. And you're also going to understand why starting with ETFs and index funds as a new or intermediate investor is going to could dramatically improve the quality of your investing and improve the results of your investing. Okay. I'm also going to tell you exactly what I look for in when I'm buying ETFs and index funds. Now, let me say this up front so we get this out the way so you guys can know what you're dealing with. Of my portfolio, about 1%, only 1% of my personal entire investing portfolio is individual single stocks. Okay. About 28% of my net worth is real estate, and about 15% is cash and bonds. And I group those things together sort of because they're low risk. And about 56% of my entire net worth is in index funds and ETFs. So again, that's just so the majority of what I have in my own personal portfolio is index funds and ETFs, right? So what I'm going to be talking to you about tonight is out of experience, not just out of speculation and not out of guessing and not from AI. One of the ways that most people mess up with money is that they start taking money advice from a random person that they see. Now, granted, I'm random, right? But I also have a YouTube channel with a lot of followers, been doing it for years and years. But a lot of people take money advice from people who look like they have money instead of taking money advice from people who actually have money. And there's a difference there, right? So, don't let the cap and sometimes I wear the t-shirts and the big beard and all that. Don't let all that stuff fool you. Okay. My goal tonight in this live is to remove confusion for you. Replace the confusion about index funds and ETFs with understanding. And you might want to bookmark this video because this video is it's giving you a high level, but it's also going to give you some good information that you typically don't see or get live on YouTube or in other places where I'm at. Looks like I'm having an issue over on Facebook. So if you were thinking of coming, I hope you guys can come over here if you were on Facebook. Unfortunately, it's not working on Facebook and I don't know why. But this talk may be an hour. It may be an hour and 5 minutes. But I won't be talking fast and trying to talk over people's heads. One of the things that bothers me personally about people who teach and talk about personal finances and money is that a lot of times they talk fast, right? Maybe it's just the Midwest in me, but when people talk fast about money, that raises a red flag in my brain for some reason. So I'm going to slow it down. And if I happen to go over 45 minutes or over an hour, it's probably because I'm answering questions and we're having a good time. Okay. So only one rule for the chat. And I see you guys are getting going in the chat, and the chat is cool. We can get going in the chat for sure. But there's just one rule: be respectful to one another in the chat, because if not, I'll boot you out of the chat and I'll hide you from the YouTube channel for the rest of your life. And I've done that to hundreds of people. So it's not a problem. So just be respectful in the chat. Let me see who we got in here. Let me know what city you guys are in. What city, what state, what county, what country, what region of the world, what continent you're on. Just drop that in the chat so I can see where everybody's coming from, or if we got a wide range. Somebody said, man, keep that winter beard growing. I'm trying, but I'm telling you, In a couple weeks, it might go off. But let's see here. I hope you'll cover overlap. Yeah, we'll talk a little bit about overlap. Two single stocks. We're live. Where you guys at? Let me know where you at. Let's see here. City, state, and thank you very much for the 700. Going over 700 subscribers. Merlin, I got to say Merlin in the house. Charlotte, North Carolina's here. Good. Phoenix, Arizona. South Bend, Indiana. Is that Larry Bird area? Mississippi. My parents are from Mississippi, by the way, Jake. Ottawa, Canada's in the house. New York City, Atlanta, West Palm Beach, Florida. Beantown, is that Boston? I think it is. H-Town is in here. We got another Mississippi, some Chicago. We got Dubai. We got Kansas. We got Georgia. We got Philadelphia, St. Kitts, Fort Lauderdale, Ohio. We are all over the map. That's what I like to see, guys. I hope I'm not yelling too loud in this mic. Wisconsin in here. Fort Myers, Florida on the west coast of Florida. Good. Tupelo, Mississippi. Mississippi. You got to say it like that. Can't say Mississippi. Mississippi. Georgia. Lima, Peru is in the house. Yes, Lima. I think I said that right. I used to teach geography, so I get really into where people are from, by the way. I like maps and all that stuff. Detroit. Appreciate the congratulations to you. From you to me. Of course, Philly's in the house. Southern Illinois. We got them all over. DFW area of Texas. So listen. We got them from all over. Everybody's got different experience. We got small town, big town, et cetera. But guess what? When we're talking about ETFs and index funds, none of that really matters. Okay. Cost of living, none of it really matters. Okay. ETFs and index funds do better than stocks. Let me say that again. Okay. In the long run, ETFs and index funds do better than stock. Listen, if you've been investing in the stock market in the last 2 or 3 years and you've seen Nvidia go crazy, you've seen Broadcom go crazy, listen, that's extremely rare what you're watching, right? Thousands and thousands of individual stocks, and you see one or two that are going crazy. That's rare. Don't think that is representative of the entire stock market always. It doesn't happen like that. So for the most part, ETFs and index funds do better than individual stocks and individual stock picking, right? They outperform single stocks, not because, there's something smarter about having them, but because ETFs and index funds, and this will be a running theme throughout tonight, ETFs and index funds remove some of the guessing that is associated with picking individual stocks. Listen, I grabbed a couple studies. Spiva or Spiva, S-P-I-V-A. If you want to do a Google search right now, you're on your phone, you're on your laptop, look up the Spiva or Spiva scorecard. It tracks the active funds and indexes, and year after year, those studies will show you that most active managers who are picking stocks fail to beat their benchmarks, which benchmarks are the index funds, ETFs, et cetera. Now, that's not an opinion. That's just hard data. Another piece of proof that you can Google is the Wharton research. That's WHARTON research that recently showed that over a 10-year period, passive index funds outperformed actively managed ones, right? Because active managers, remember this always, and we'll mention it later too, actively managed funds usually have a higher cost. Those are the fees, right? And active managers tend to slip up on timing and things like that, right? So I just wanted to lead with a couple of studies so you can Google those studies and you can say, hey, this smart money bro guy's coming on YouTube making stuff up. No, it's research, right? It's research. It's not theory, right? Long-term wealth is built by doing the research and understanding what the data says about which is better between the index funds and ETFs versus individual stocks. So before we go further, before we dig deeper, because we're going to dig a little deep, we're going to stay high level, but dig a little deep. Before we go deeper, we need to clear up something real quick, because a lot of people use these words without actually knowing what they mean. Okay, so I want to talk about real briefly up front, what is an index fund and what is an ETF? Now, some of you may be saying, hey, this is basic stuff. That's cool, right? Nothing wrong with going back to the basics, right? Even Steph Curry got to do some dribbling drills, right? So, what are the differences between the two and how to buy them? So, it's important that you know that an index fund, guys, you hear the word index fund all the time. An index fund is a type of mutual fund. So, there's different types of mutual funds, and one of those types of mutual funds is an index fund. Okay. Typically, what is the difference between a big mutual fund and an index fund? Well, a mutual fund is typically actively managed by a fund manager, typically. So, typically, with a mutual fund, you're going to be paying higher fees. Those fees are what pay the salary and the administrative cost of the people who are actively managing the fund. So, when you hear the term mutual fund, that's one thing, but remember, index funds are a type of mutual fund. Mutual funds are what's considered to be actively managed. And index funds are typically considered passively managed because they're just following an index, not being actively managed. So the fees for index funds are typically a little lower, right? So index funds are just owning everything in a specific market index or a bucket. So an index fund, an ETF, and we'll kind of interchange those. I'll tell you the difference between those in a minute, but index funds are just a bucket of stocks. Mutual funds are a bucket of stocks that has a bunch of managers standing around the bucket, pulling stuff in, taking stuff out. You got to pay their salary. So the fees to manage a mutual fund are higher. The fees to manage an index fund are lower because they don't have the active managers, right? So think about like the S&P 500, right? That's the top 500 plus companies in America, right? In terms of cap, right? Highest caps, most expensive. Think about the total stock market. That's another type of index fund, right? Type of index. Think about the NASDAQ 100. You've heard of that. That's a bucket of mostly tech stocks, right? So those are examples of indexes. S&P 500, total stock market, NASDAQ 100, Russell 3000, right? These are the types of indexes that are out there. And there's many that you haven't heard of, right? These indexes are not designed to beat the stock market. And here's the one drawback of index funds, guys. Index funds are really trying to match or mimic or mirror, whatever adjective you want to use, the market or index that they track, right? So I just jumped right in, guys. I hope you guys didn't mind me just jumping right in because I want to get this thing on the ball. Don't want to hold anybody up. But when the market or the group or bucket of stocks goes up, then that index goes up. You'll see it go up. When the market or group or bucket of stocks that you have called an index fund go down, then that index goes down. Here's the deal with index funds, right? There's no guessing. There's no trying to pick the winners. Who should we put in the bucket? Who should we take out of the bucket? This stock, that company, this company. You don't have to worry about all that. You don't have to try to decide, right, what goes in the bucket and what doesn't go in the bucket. You don't decide that. You just buy the bucket. Of course, you got to know some things about the bucket and what's in the bucket and all this type of stuff. We'll talk about it in a little bit. But you're just buying a bucket of stocks when you're buying index funds. By the way, let me welcome in my folks over from LinkedIn. Good to have you. I'm sorry I didn't get a chance to get my folks over at I'm sorry I didn't get a chance to get my folks over at Facebook in. I'll run the replay for them. Welcome in IG. Glad to have you here as well. All right. Let's see here. Somebody said, I'm just going back to the chat before I jump into the next part. Every now and then I want to swing back over here to the chat. Guys, for Saturday and Thursday, I'm sorry, was it Saturday and Thursday? Yeah, every Saturday and Thursday, maybe it's Thursday or Monday, for about a year and a half, I used to do these lives all the time, right? All the time. I stopped doing them about a year ago. So some folks are still with me, some are not, but that's okay. Let's see here. I'm just kind of running through the chat, seeing we got every now and then I'll look back at the chat, guys, as we have this conversation. Somebody said, what about bond ETFs right now? Okay, those are cool too. Got some of those. Somebody said gold, silver question. We're looking to work for 2026. We'll get there. We'll get to some of the questions. San Diego and Detroit's in the house. Good to have you. What is an ETF? Now, we talked about what a mutual fund was. We talked about briefly what an index fund was. Again, we are just trying to explain these things and tell you why most people lose at this investing thing, right? And I believe that index funds and ETFs actually work much better for most people. What is an ETF? An ETF is, again, simply a bucket of stocks. Remember earlier when I said S&P 500 is an index, total stock market is an index. NASDAQ, well, ETFs that are the equivalent of those would be like your VOO, your VTI, your QQQ, right? ETFs are just a bucket of stocks also. All right. So it's just like an index fund, except there's a few differences, right? But an ETF, like an index fund, instead of buying one single stock, you're buying many different companies at the same time in that bucket. All right. This is why you hear ETFs and index funds sort of used a lot interchangeably because they're virtually the same thing with some differences, some minor differences, right? So before I go further, let me hit on some of those minor differences. Look, this is the type of video, like I said earlier, you need to save this video. If you have a new person, a young person, or even an older person looking to invest, you need to share this video with them as well, right? Because I'm going over some of the real basics of investing in the index fund and index funds and ETFs, right? But the minor differences between ETFs and index funds, and this part sort of confuses people, right? Because while they can look similar, there is some differences. ETFs trade throughout the day just like a stock. You can buy and sell ETFs during the trading day, right? While the market is open. You can buy them and sell them. These are buckets of stocks that you can buy and sell just like single individual stocks. Index funds only trade once per day after the market closes. That means index funds have the same end of the day price. ETFs, the price changes throughout the day because they are being traded throughout the day. ETFs are, right? So ETFs sort of, how would I say it? ETFs sort of move in real time like stocks do. You look at the stock at 9:30 in the morning, the stock is 100 share, and by 2:30 it's 101.30 or it's 97 point. ETFs do the same thing, right? ETFs require you to buy shares just like a stock. So you place a buy or sell order, it's a share. But remember, ETFs are just a bucket, right? So index funds are bought directly from the fund company. You invest a dollar amount in an index fund, right? You don't buy shares of index funds, right? ETFs, another difference is ETFs usually have no minimum investment to get into them other than the price of one share of the ETF. But that you have a lot of index funds that require a minimum investment, right? When you go over to Vanguard, you'll see what they call Admiral shares if you're over on Vanguard as a platform. And sometimes there's $1,000, sometimes there's $3,000 to get into an index fund. Sometimes over there is $10,000 to get into an index fund. There's some index funds that have a $100,000 minimum to get into. So ETFs are easier for people to start with, kind of a lower barrier of entry than a lot of index funds. Not all index funds, but a lot of them, right? So index funds typically require a little more capital to get into them. But again, ETFs and index funds are very similar, right? Again, ETFs, the prices change constantly based on supply, demand, trade volume, et cetera, what's happening on the market that day, right? Index funds are not like that. So ETFs have a little more complication than index funds because they can be traded like stocks throughout the day. So people can trade them often. There's some market timing and there's other things involved with ETFs because they're sometimes treated like an individual stock that can be traded, right? But index funds, you can't react to index funds throughout the day because they have one price. So ETFs do tend to be a little more flexible. You can do some things with ETFs, right, that you can't do with index funds, right? There's a few tax implications. I'm not going to dig into the tax implications, the differences between ETFs and index funds, right? But ETFs typically are seen to have sort of a little tax advantage without going deeper. Bottom line is this about the differences: index funds and ETFs can hold the same bucket of stocks, but they sort of differ in how they're traded throughout. One's traded throughout the day, one's not. How they're, how they can affect investors' behavior. And I look at them as the same, right? And most people do sort of look at them as the same. Just know that there's some slight differences, right? Let me see what we got in the chat. Every now and then we have this conversation, guys. I'm going to jump down here in the chat. If there's a question, I know there's probably a question. I might have missed one or two or three. Somebody back up there said 401k or an IRA. That just depends. We got Wichita, Kansas in the house. It really depends on a lot of situations, which one you choose, which ones you want to max out, etc. Somebody said, good question. What was the question that Coldwater put up there? Let's see here. Appreciate you listening to me while you're on the road there. Somebody's a trucker. Yes, I'm familiar with the Bogleheads. Absolutely. John Bogle, Jack John Bogle was the person who invented or started Vanguard back in the early 70s, right? Let's see here. Active managers or gamblers. All right, let's keep rolling. Let me see here. Which one is better, ETF or index funds? It depends. I think they're so similar, it doesn't really matter. If you plan to be in there trading them, ETFs. But for me, I got a little bit of both. Okay. But I got mostly ETFs, but I got a little bit of both. Okay. Do I think VT over VOO for a long term? I'm a VOO guy. I like VOO. VOO is the S&P 500 ETF, for those of you that don't know. We have let's see here, VO. Okay, we got some people putting their ticker symbols in there. That's all good. Nothing wrong with that. Let's go on. Let's move on. Let's talk about what I look for specifically when I buy ETFs and index funds. There's 10 things. I'm going to go over these kind of quickly. But again, if you have a question, drop it. If you're watching this on replay on YouTube, drop the question. I'll be more than happy to answer the question for you. First thing I look at is an expense ratio. How expensive is it to own the index fund or ETF? The expense ratio is basically the annual fee charged by the fund as a percentage of your investment, right? Because these fees that you have to pay because of the expense ratio, these fees really come from your returns, right? So the higher the fee, the more you're paying to own the firm, the actual fund, right? A small difference in a fee over the course of 10, 15, 20 years could make a big difference. And there's many studies to show that. I don't want to show you any studies right there, but there's many studies that will point that out. It can really result in tens of thousands, maybe hundreds of thousands of dollars, depending on the volume we're talking about. So fees matter. I look at fee. I like low fees. I'm a little leery of some of the Fidelity's got some no fee funds, which I haven't really dug into those yet, but fees, I do look at them. I look at the number of holdings in the bucket, right? I look at the number of holdings in the bucket, holdings being how many companies are in the bucket. A fund that has 500 companies is going to offer a little more protection. When I say a little more protection, I mean a little less risk than a fund that only carries 50 companies in the bucket, right? If you get VTI, for example, which is an ETF that has all of the stocks in America in one bucket, VTI, I mean, you've got a ton of companies, a lot of diversity. But remember, the more diversity you have, the less risk you have, but the less possibility for greater returns you have, right? Hope that made sense. Other thing I look at besides how many companies are in the bucket is I look at what asset class is this in? Is it a large cap, large capitalization? Those are big companies, large, big companies, stable, well-established companies. They're large cap. Is it a mid cap? This is the asset class in the market cap. I'm sorry. Mid cap, or is it small cap? which small cap has, these are smaller companies, smaller capitalization, worth less, not worthless, worth less, which small caps have the opportunity for higher volatility, go up, go down a whole lot more than large caps. Large caps do this, small caps do this in terms of volatility, how volatile they are, right? So I look at asset class and market cap, large, mid, small, right? I also look at the weighting. And when I say weighting, I'm talking about how much weight a fund, or I'm sorry, how much weight a company holds, or what companies are the top 10 weighted companies in the ETF or in the index, right? There's funds, ETFs and index, but that don't have different weights for the companies that are in the bucket, right? But the S&P 500, for example, the bigger companies weigh more in the bucket than the smaller companies. That's what we mean by weighted, right? So I check the weightings of the different holdings companies in the bucket and see which companies are the heaviest in my bucket. I'm trying to use analogies so, we can, I know that for some of you, for many of you, this is basic, right? But there's some people on here that don't invest yet and they're thinking about investing, right? So market cap weighted funds give more influence to these larger companies because the larger the company, the heavier they are. Again, there's some what they call equal weighted funds out there where everything that's in the bucket weighs the same, right? Those are called equal weighted funds, ETFs or index funds, right? Now, the fifth thing I look at is I look at portfolio overlap. I'm just giving you all these things because if you're not in, listen, let me back up and say this. If you're not investing with some type of system, some type of plan, some type of method to your madness and what you're doing, you're missing the boat. You're honestly missing the boat. And I know there's a lot of people. I'm going to keep it a buck with you. Okay. I'm going to be honest with you guys. There is a lot of people who invest in the stock market and they have no plan at all. I'm going to say, and I've talked to probably at this point close to 600 people or more about their money one-on-one, right? I have a Patreon. I have people in my VIP Patreon. It's in the link below. And if you're on YouTube, and these people, we have monthly conversations about their money. Not to mention, for 2 years on this YouTube channel, I did free 15-minute conversations. And so I also do one-on-one coaching, right? And I'm going to say that 90% of the people that I've talked to about investing have no plan, zero. They're just winging it haphazardly. Oh, I saw that on TV. I saw Kramer talk about that. Cool. Let me go buy that. Oh, I read an article about this. Let me go buy that. Oh, Nvidia's blowing up. Boom. Let me go buy that. Have no philosophy. Just throwing spaghetti at the wall, basically. So what I'm telling you, when I'm giving you these 10 things that I do, I'm telling you, you need to have a method to your madness. You may not have 10 things. You may have 3 things. You may have 4 things, right? But you got to have something. Don't buy an index fund or ETF because I said VOO is a good move. Don't do that. Go do some research. Put some work in. Listen, ETFs and index funds are easier to invest in than in single stocks. That don't mean you ain't got to do your work. You still got to put in some work. You still got to dig in and do some due diligence, right? Don't be the investor that doesn't want to put in the work, but wants all of the benefits. And I know that's a lot of people. So I'm speaking to a lot of people. Listen, I'm just trying to keep it real with you. The fifth thing I look at is portfolio overlap, which somebody said in the chat earlier. We're talking about overlap. You want to check for overlap when you're buying more than one ETF or index fund. You don't have to own VTI, which is an ETF that covers the entire stock market, all of them in one bucket. You don't have to buy VTI and also at the same time own VOO, the 500 top companies, because in VTI is the 500 companies that are in VOO, the S&P 500. You just got two different ETFs for no reason because all the companies overlap. So you don't want overlap. It's totally unnecessary. Don't mistake being busy with getting a whole lot done, right? Or activity as progress. Oh, I own this and I own that and I own that and I own this. And guess what? All four of them things you own, they all overlap each other. So you can really get all that in just one. So you have to be understanding portfolio overlap, not just ETF index fund portfolio. But listen, if you own VOO, the S&P 500, do you really need to go out and have NVIDIA, Meta, and Google or Alphabet, Meta, NVIDIA, and Tesla? You got all those single stocks, but you also own the S&P 500. Well, those big stocks I just mentioned, they're in the S&P 500. Matter of fact, they make up 35-40% of the S&P 500. So not just overlap from ETF to ETF or index fund to ETF, but overlap in terms of your entire portfolio. I don't care if you own $1,000 worth of stock, you have a portfolio. I don't care if you own $500 in ETFs, you have a portfolio. You ain't got to have $100,000 or $2 million to call it a portfolio. That's just a fancy name for your stuff, right? You got stuff. If you got investments, you got a portfolio. Man, I'm going off on tangents. Let me get back. Number 6, the sixth thing that I look at, and I don't look super heavy because the tracking is not terribly off, but I look at tracking errors. What does that mean? For index funds, the tracking error measures how closely the fund follows the benchmark that it's supposed to be following. When you have an ETF or index fund that have high tracking errors, that suggests that the fund is sort of failing to replicate the index. Remember what I said earlier? Index funds, ETF, they are designed to mirror a certain index, a certain group of stocks. And if they don't mirror it properly, then you get these big tracking errors. You don't want to see that, right? But typically these tracking errors are either from high fees or it could be, some poor administrative stuff going on that you don't want to deal with. Seventh thing I look at is dividend yield. I always reinvest dividends, right? I don't seek passive monthly or quarterly income from my investments, right? So I look at, but I do look at, is it paying a dividend? What type of dividend? What's the dividend yield? Yield just meaning what percentage, right? The eighth thing I look at is assets under management. We call AUM, right? And I also kind of peep out what's the trading volume, meaning how much if I'm ETFs, right? How much is going on every single day, right? I look at that. I look at tax efficiency. Of course, I said earlier, ETFs a little more tax efficient. And I also number 10, and it's number 10 for a reason, but I do peep out the performance, right? And I know most people put that first, but I like to kind of look at some other things before I look at the performance. Past performance does not guarantee future results, right? Disclaimer. But I like to look at the 1 year. I don't look at the 6 month, but I look at the 5 year, right? And then the lifetime, like the fund has been in place since 2002. I want to look at the last 24 years. How's it done? Right? And I like to look at how it's done against other ETFs that are similar, not the same, but similar. Right? So let me check the chat, man. I'm just going on and on and on, guys. I just like to get it going. Good to see you here. Let's see here. SMH, SCG. Okay. We got some winners in there. Let's see here. We got Fayetteville, North Carolina said, I work for the post office too. I work for the federal government. But post office is government too, I think, right? Somebody said, "What age did I make my first million?" I didn't become a seven-figure person until I got over 50. So I did it the slow way. Let's see. So should I have many index funds? No, you don't need many index funds. You don't need many ETFs, right? That's the beauty of index funds and ETFs. You don't have to have a whole bunch of them. Remember, one of them is a bucket full of stocks. You could have, let's say you might have, let me just name one, MKG, and you can Google MKG. I think that's tech at Vanguard. You could have, and it has about 80 or 90. But if you own that one ETF, you have 80 or 90 stocks already. That's good diversity. You ain't got to have, 17 different ETFs, right? Okay. I'm just looking at the chat real quick, guys, as we continue on. Let's see here. Did I miss any big major questions, guys? All right. Let's see here. If you get 20 or 30 years one way, VOO is cool. If not, more concentration could be needed, perhaps. Yep. If you're beating the market, the expense ratio isn't a big issue. Not necessarily, but it matters over the course of a long stretch, right? Expense ratio really don't matter if you got it for 3 or 4 years, but if it ain't gonna be that much. But if you hold it for 15 years, it could matter. Let's see here. I use VTI in my Roth. My TSP has the C fund. Yeah, I got a lot in the C fund as well. I'm a C fund person as well. That's TSP is Thrift Savings Plan if you work for the federal government here in America. Just seeing. Good evening to you. Good. It looks like we got the chat going pretty smooth, guys. I appreciate you guys participating in the chat and being responsible as well as far as keeping it pleasant. Oh, you still got to know what listen, what do I invest in? I have a portfolio. I go deeper over on Patreon. I have a Patreon and I got folks, if you want to join the Patreon, there's a link in the description box below here on YouTube. I go deeper on Patreon. I don't really go a whole lot deeper on YouTube. I used to, but as I've going on a little bit bigger and gotten bigger in terms of subscribers, I sort of stopped doing that a little bit as much as I used to. VOO and VGT do overlap. Absolutely. You are 100% right. They do. Let's see. Any questions? Let's see here. That's tough when you're trying to answer a question. Somebody said cross the 1 million today. Congratulations to you. Love to see that. Fantastic, man. That is solid. All right. Quick thought. Let me say this real quick before we keep going. I got a bunch more. All right. Check out this book, Manage Your Way to Millions. I put this book on Amazon. I wrote it and put it on Amazon back in October. So it's been out about 3 months and it's already in the top 10. It stayed in the top 10. It's been there for a long time. Top 10 in 2 different Amazon categories and top 50 in 2 other Amazon categories. You can get it in Kindle, paperback, hardback. This is a blueprint. Easy read, a blueprint, 120 pages to manage your money. It's real, it's practical, and it's full of solutions, right? About how to manage your way to millions. So there'll be a link to that in the YouTube chat below. I just want to make sure. Also in the description box. I said chat in the description box. Also, free gift for you. It's a free debt snowball worksheet with instructions. Super helpful if you're trying to get out of bad debt, which we talk about a lot on this channel, getting out of bad debt. So check out that freebie in the description box as well. So let's go a little further. Here's why all of this focus on ETFs and index funds matters, guys. Most people believe that success in investing comes from finding the right stock. And that could not be further from the truth. But I don't know where we get this belief that if I just find the right stock, people look at the stock market like it's gambling. Okay. That belief alone, that all I got to do is find the right stock, is why a lot of people lose in the stock market, right? ETFs and index funds don't work for a lot of people because they don't They're not exciting, right? But they work because they remove predictions. Okay. The less you have to guess when it comes to investing, the more likely you are to win. Did you guys get that? The less you have to guess, and no doubt, even when you're doing your due diligence and you're reading the 10Ks and the 10Qs and the earnings reports and balance sheets and the free cash flow and the PE ratios from individual stocks, even when you're doing that, you're still guessing. If you can remove the guessing, that's like 90% of the battle when it comes to investing in the stock market. You remove the guesswork of which stock to pick. When should I buy it? But here's the big one that you remove, that you remove when you invest in ETFs and index funds, that you have to figure out when you're investing in single stocks. When do I sell? Because most people lose in the individual stock game because they don't know when to sell. They don't know when to get rid of it. They hold on to it for too long. It could be some emotional reason. They have some, man, that was my mama's stock, 30 years ago, and I'm holding on to it, right? Don't know when to let it go. You dramatically increase your odds of success in the stock market when you remove guessing. But and here's most people don't lose in the individual stock picking game because they're just lazy, although that's a piece of it. People don't do their due diligence. But here's the problem. The individual stock game makes people lose because it feeds on our emotions, especially the emotion of exuberance, hype, right? Excitement. Oh my gosh, that stock is doing that. Let me go buy some of that. And by the time you go buy some of that and you log on and you try to buy it, you missed it because you're trying to time it, right? So these emotions that we have, oh no, it's going bad. Oh my goodness, I got to sell and get out of it. And emotion, that's fear. Fear is an emotion. Excitement is an emotion, right? ETFs and index funds win for most people, not because they're exciting, but because they're just consistent. You buy a bucket. You don't have to pick what goes in the bucket and what goes out of the bucket. That ain't yours to do. You just buy in the bucket, right? The bucket will, what they call that, sort of self-cleanse itself, right? So let me give you this example. Let me give you another analogy because I like analogies, right? Here's how I think about index funds and ETFs versus or compared to single stock investing. I'm a former basketball coach, right? So, and I coach youth basketball, middle school, high school, girls, boys, probably for about 13 years or so, right? This is the best way that I can think of this whole thing, how I look at index funds and ETFs as opposed to stocks. When you're a new investor or a beginner investor who jumps directly into individual stocks, that's like somebody walking into a gym. I'm coaching. They walk into a gym, have never played basketball a day in their life. They want me to teach them how to play basketball. But the first thing they do when I roll them the ball is they go behind the 3-point line and start shooting threes. Wait a minute. I'm like, hold up. You don't even know how to hold the ball. You don't even know how to manage your feet. You don't even know what balance is. You don't understand the concept of lining up your elbow with the rim and the follow through with your shot. Yeah, that's a nice shot, though, by the way. Hold on, let me get it right. Bam. Just so you know, slack them. So anyway, you know what I'm saying. So the point is that you're coming in fresh and brand new, trying to enter into a game that's complex called individual stock picking, and you ain't never even been around the market. You ain't had your emotions tested, right? But you want to walk right in this gym, grab a ball, and go shoot from the 3-point line. You haven't learned the shooting mechanics. You haven't learned where to place your hands here, here, one up here, one down here. You don't know what to do, right? You don't even know how the ball should look going off your finger. You don't even know what it feels like to make a shot. But you want to stand behind the 3-point line and just start firing it up. That you want to be Steph Curry and you ain't never shot a ball. That's exactly what people do when they start investing. And the first thing they do is run towards individual stocks that they heard somebody talk about. You would be shocked at how many people invest like that. I may be talking to you, maybe you, right? You can't skip through all the mechanics and skip through all the basics, right? On a basketball court, how do you learn? You learn by shooting close up, practicing your form, making all the layups, right? If you can't make 90% of the shots sitting right next to the goal, 95% of those, what you going back to the 3-point line for? Make your layups, left hand, right hand. Build confidence, right? Build some discipline. Understand how to shoot regardless of if the last shot went in or went out. Repeat the basics over and over and over and over thousands of times. Then we'll move you back to the 3-point line. Then we'll move you over into individual single stocks because that's a lot more intense. Only after you understand the mechanics. Only after you built some consistency. ETFs and index funds, watch this. ETFs and index funds are the layups of investing. But a lot of people skip the layups. Index funds and ETFs teach you discipline, patience, how markets move and don't move, how to control, your thought process and your emotions, how to stay in the game. This is what ETFs and index funds teaches you. Single stocks, right? Balance sheets, free cash flow, earnings per share, right? Whether a stock is trading 10 times earnings or 20 times earnings or 50 times earnings, that stuff is the 3-pointers of this game. There's nothing wrong with it, right? Because when you watch a high-level game, you want to see somebody knock down them threes, right? But you got to earn the right to get back there and shoot the shots from 15, 30, 25 feet away. Right? And this is why I tell people, if you're new, start with index funds and ETFs. I didn't say stay shooting layups. Start with layups. Now, listen, let me say this before I forget it, because I forget this stuff. I'm putting together a 30-day money reset starting in February, just a couple of weeks. It's a structured, guided, and focused move with your money. And it's going to be designed to help you get clearer, be organized, and be intentional with your money and your investing. It's a system with your money. Because a lot of people will tell you, get out of debt. A lot of people, bad debt. A lot of people will tell you what to invest in. A lot of people get some additional income. A lot of people will tell you, hey, do a budget, but they don't show you how to do it. They don't walk you through it. This 30-day money reset is going to walk you through it. I got more details coming soon. I just want to give a quick mention of that, right? Now, let's talk about real briefly why stock picking is harder. We kind of hit on it a lot, right? But you're making guesses on a regular basis. You're sort of guessing about the management of that company. You're sort of guessing about when's the right time to buy and sell. You're sort of guessing about, is the company growing or the company not growing? You're sort of guessing about whether or not they're going to have a good earnings report or a bad earnings report, right? Everybody ain't going to be TSMC like we saw Taiwan Semi today, great, or a couple days, yesterday, whatever it was, great report. That doesn't happen always. But you're sort of guessing about the accuracy of the news reports or the things that you see on social media when you're reading articles, right? You're sort of guessing about, I have a good feeling about this stock. I have a bad feeling. You're playing the lottery. All that means is you're taking on more risk and you're taking on more volatility. Most people, watch this. Most people think that they're investing, but what most people really do is just guessing. And guessing can feel like investing until you guess wrong, right? I mean, have you ever lost $2,000 in the stock market or $10,000? That ain't a fun feeling, right? People always say, hey, I'm a long-term investing until they get tested in the market with their individual stocks. Then you see people panic selling and chasing hype and all that stuff, right? And I like to tell people, hey, the stock market doesn't take your money. Your reactions to the stock market is what takes your money, because you don't lose until you sell, right? I ran a poll. Let me see if I can go to the poll. I ran a poll today on YouTube. I put a poll out there this morning, or maybe closer to this afternoon, and the poll said, how do you invest right now? And I'm looking at the results of the poll. I've had 2,200 people that have actually responded. And thankfully, 57% of the people said, I invest mostly in ETFs and index funds. But here's the problem, in my opinion. The problem is that, what did the other, 43% of the people say? There were 4 choices. The question was, how do you invest right now? The possible responses was mostly ETFs and index funds, mostly individual stocks, mostly real estate and other alternatives like crypto and those things. And then finally was, I'm not investing. And 43% of the people were either in individual stocks, real estate, or not investing. 21% of the people said not investing yet. That is a huge amount of people. So 43% of the people were not mostly in ETFs and index funds. That's startling. And it makes this type of live or this type of talk super important, because half the people are, but the other half of the people are doing some other stuff. That's not horrible, but man, I was expecting to be more like 60-70% of people investing in ETFs and index funds, right? But I thought that was interesting. But ETFs and index funds, they work because they align more with the fact of reality, less guessing, less emotion, and you become more, it's easy to become consistent. You don't have to always be right, right? You just don't have to always be right. Trying to beat the market with individual stocks is like shooting from behind the 3-point line and you ain't never shot and just hoping it goes in. Hope, guess. But here's the difference. When you own the market through index funds or ETFs, you're really standing right next to the basket. It's way less risk, way less guessing, right? You own the market instead of trying to outsmart the market, and ultimately you'll do better with ETFs and index funds, like I mentioned those studies from earlier, right? And then here's the deal. Some of you are probably going to say, well, how do I do this? What do I do? That's the right question, right? If you're already investing, it's nothing you have to fix overnight necessarily, but you do got to put together a little plan for you where you can kind of begin to shift some of your future investing, or even some of what you already have, rebalancing, whatever it could be, or sell what you got and buy whatever it could be, right? And that's why I mentioned the 30-day money reset we're going to be having in February, and I'll share, like I said, details about that soon. But at the end of the day, you got to know that investing success is not about how intelligent you are. It's really not. It's not about how well you look at qualitative and quantitative information based, from the companies you invest in. It's about removing extra decisions that you don't have to make when you own a bucket full of stocks. Again, you don't have to decide what to go in and when to take them out. You remove that decision. Removing that decision removes the hope and the guessing and all that, right? Let me see. I haven't been to the chat in a while, guys. Bear with me. I get to just rolling with this stuff, right? So let me see what we got here, guys. I'm just going to run back to the chat, see if there's anything I missed or missing. Guys, let's all buy. Hey, thanks. Appreciate that. Let's see. What's your opinion on foreign exposure in funds like VXUS? I typically don't keep a lot of international exposure in my own portfolio. I typically don't. Why? Because Alphabet, Meta, Apple, these give me enough international exposure because they're worldwide companies. So if I have those in my portfolio, me personally, I feel like I got some international exposure, even though I don't have a specific international ETF or index fund. So I don't keep a lot of, I keep a little bit. I have one fund over at Infidelity where I do have a little bit of international, I have quite a bit in that particular fund of international exposure, but that fund is only a tiny bit of my overall portfolio, right? So I don't like to have a lot of international because I own big companies and these big companies are worldwide companies anyway. Hope that answered your question. Good question. Let's see here. Somebody else said day trading is gambling. Yeah, I'm not a day trader. Somebody says with active. Okay, I'm just looking through to see if there's any questions. Maybe I don't want to sell. Boom, boom, boom. The great Warren Buffett once said, the first 100K is a tough one, but you got to do it. Yeah, first 100K is tough, but you can get there. Hey, Toronto, Canada's in the house. Let's see here. I like SCHD. I'm not going to rain on any ETFs parade because if you like it, that's cool. Let's see here. You're doing the words work. Oh, that's good. Thank you. The face voice. Thanks for boom. What platform will it be on? Now, when it comes to platforms, I like the big three: Schwab, Fidelity, Vanguard. I have accounts at all of them. However, I think the interface for Schwab, I like it a lot. Fidelity has a pretty good interface too, pretty easy to read. Vanguard probably has the toughest to read, but I sort of like the company of Vanguard, so I always have something over there as well. If you have apps and you're doing this thing on Robinhood and all that, that's cool too. I just don't usually do this stuff on apps. Thank you for the wealth of information. I will watch the remainder of the replay. Perfect. Thank you so much for being here. Let's see here. You don't lose till you sell or the company goes. Chapter 8, chapter 7. Yeah, I think it's chapter 8. I've been looking at this all week. Let's see. Everybody's talking about VXUS in the chat. But the reason, guys, that I wanted to do this live tonight wasn't to hype anything. It wasn't to, say, hey, go buy this or go. No, it was really what I really want to do here is I want to demystify ETFs and index funds for beginners. Okay. And even for people who've been investing for a while, sometimes it's good to take a step back and say, okay, I've been investing in this thing, but really, what is this thing? Right. If you want to reduce your risk, invest with less emotion and less work, to be honest with you, starting with ETFs and index funds, or at least building your foundation of your portfolio around them, should honestly be your first play. Let me say this too, because I haven't said it yet, but I need to say it. This is important. Pay attention to this, guys. Very important. When you invest in individual stocks, you have the opportunity to really, really get some huge gains. You have to realize that. If you could have put 10 grand into NVIDIA, 10 years ago, you'd be a millionaire, maybe several times over. So when you invest in individual stocks, there is an opportunity for some incredible wins. But guess what? You probably know what I'm going to say. When you invest in individual stocks, there's also the great potential for some incredible losses, right? You have to understand the game of risk when you're a new investor, whether you're going individual stocks, ETFs, index, you have to understand the game of risk. And the fact that individual stocks offer these really big potential gains, you also have to realize they offer a lot of losses. So there's volatility and increased risk when you're investing in individual stocks. That's why when you invest in ETFs or index funds, you reduce that risk, but you also reduce the opportunity to have these incredible gains. Because remember, ETFs and index funds are not designed to outperform the market like an NVIDIA, right? They just are not designed for that. They're designed for less risk, right? I just wanted to make sure you understood that, because I don't want to get out here and say, hey, there's no risk involved with ETFs and index funds. They're easy. They're not. Everything involves risk, right? Taking $100 and putting it under your mattress at home is a risk. Taking your emergency fund of $5,000, $10,000, $20,000 and putting it in the bank is a risk. That's a risk. What is the risk? Well, you're only getting 0.0002%, where you could have took that $20,000 and put it into VOO and made 17% last year, 2025, right? So there's risk in everything with money. Index funds and ETFs are no different. But there's a little less possibility of those huge gains, but that comes with less risk, right? So I wanted to make sure I mentioned that, because I don't want to hype it all up without letting you understand that you're not going to get an NVIDIA, moment in an ETF. If NVIDIA is part of the ETF, you'll see some gains from it, but you're not going to make $1 million out of 10,000 in 10 years like you could have if you invested directly in NVIDIA, 10 years ago. Right? ETFs and index funds are how you learn this game. They're how you stay in the game. They're how you start to understand the game, how to manage your discipline, manage your emotions. And then once you build that foundation, then you decide what comes next. And it could be individual stocks. But don't walk in the gym shooting threes and you ain't never picked up a basketball. I'm going to look at you funny. You're going to miss every shot and you're going to lose confidence and you're going to be done with the stock market. You'll be mad. Come on up here and shoot these layups real quick. Let me show you how to get that form, get the ball right over the front of the rim. Let me show you how to use that square on the backboard for angles, right? Let me show you how to walk in the gym and make 50 short shots from this side, from that side, from right in the middle, then step back and make about 20 from the free throw line extended, right? Then we can get back in the gym and start shooting threes. But that's first, right? So tonight is about clarity. It's about trying to get clear about why ETFs and index funds actually work, right? And help you try to sort of explain them and help you understand them. Let me go back to the chat, guys. And I get on these tangents, so you got to bear with me here. Let's see here. I did not even start investing until 46 years old. And I'm 55 now and I have a medium and six-figure portfolio. Fantastic. Because I watched the guys like Smart Money, bro. Appreciate you. And I put a lot of money in and got out of debt. John, is that John Joe? Let me know if that's you, John Joe. Good to see you on here, man. Thank you for that shout out. I'm new to investments. I signed up for Digital Advisor. Is that a good idea? Should I manage it on my own? To start, I suggest you manage it on your own to start. Just to start. And I suggest you read and you understand and you grab books to help you understand and you watch podcasts that help you understand and you learn and read and study first. It's the same thing. Let me say it like this. I own real estate, right? I've owned real estate for 25 years. If somebody said, I'm going to buy a piece of real estate, I've never owned real estate, but I'm going to buy a piece and I'm going to get me a property manager. I would say first, before you get a property manager, you need to spend a year managing your own property. Why? Because in that year, you're going to learn so much about how to get a tenant, what a door costs, what does a threshold cost, what's carpet cost, what does it take, what is fascia and soffits, and how does the roof, and what is downspouts, and how do we make sure the elbow on the gutters and the grading around the house. And you got to learn some stuff, because that's going to help you hire a property manager better, the right property manager, if you first know it. So investing in this is the same way. And I'm not sure, in terms of what depth your digital advisor goes, but first learn it on your own. If you watching this video right now and you're a mechanic, you can learn money. If you're a nurse, you can learn money. If you're an engineer, a doctor, lawyer, you definitely can learn money. I don't care if you work at a warehouse or you flip burgers at McDonald's, nothing wrong with it. But if you can learn to do that, you can learn money. This thing doesn't have to be complicated, but people make money complicated, so you pay them to manage it for you. So before you hire or bring on digital this, digital that, do it yourself so you can get a feel for it and learn it and understand it, right? And then when you get somebody to help you, you'll know what they should be looking at, right? So I hope that answered your question. Let's see, what returns to you general with ETFs and index funds? Returns can be anywhere, 5% to 20%, just depends, right? So returns can be all over the place. How can beginners avoid overlaps in ETFs? Let me tell you a good place to go, Jesse Cat. A good place to go is go to ETFs.com. On ETFs.com, you can compare, right? Or you can put it in Google and just say VOO versus QQQ. Put that in Google and it'll take you to some places that'll help you compare and check for overlap, right? Let's see here. And I'm going down the list real quick. I like Schwab too. That's what somebody else said. Do you work also with managing broker and you also manage it your own? I have Empower, not Satisfied. I'm not sure what Empower is, but no, I just manage my own accounts at this point. Always have. Sounds like some SMB, sounds like some growth stock. It sure does, doesn't it? Interesting. Let's see. I work for Charles Schwab, and because I'm in a regulated industry, I can only have a Schwab brokerage account. Which index funds do you recommend for beginners? I like broad-based index funds for beginners. When I say broad-based, those are your VOOs, your VTIs, et cetera, right? Maybe even it depends. Again, you want to look at, do you want to have large cap? Do you want to have mid cap? Do you want to have small cap? Do you want to have a combination of all? After you check over your portfolio, the first thing you should do before you go buying anything, if you're new, the first thing you got to do is figure out, what is your philosophy? What do you think? What is your plan? What do you want? What is your goals? Because all those things are going to help you shape what your portfolio should look like. So I could say, hey, I like broad-based, but you may not. You may be in the healthcare industry, right? And you want to get healthcare ETFs and index funds. You may be in the real estate, want to get REITs. The point is, figure out who you are in this game and what you want in this game. And the answers to that is going to help shape what you should be investing in. Kind of a different way of looking at things, guys. But this is the way that an investor who really wants long-term growth and to do it the right way, this is what most people should be telling you how to do it. They shouldn't just be telling you, hey guys, I got a hot stock tip. Here's I got a hot, no, that hot tip may be hot for you, but may be cold for me, right? The hot tip may be fitting right into your portfolio, but it don't mesh because I'm a 65-year-old person and I don't want the volatility. So I need something different. This is why you have to tailor your portfolio and what you buy to you. And this don't win me a lot of views, right? I could get on YouTube and start talking about, hey, this hot tip and the 5 top stocks you should, right? But I don't like doing that because I want to set you up for long-term success. And the best way I can get you to long-term success is to give you the tools the thought process that matches you and explain to you. But at the same time, you got to do your own due diligence. You got to do your own research, right? Don't be a lazy investor. The Walla Mala's in the house. Man, I haven't seen that name in a long time. He said you could put 10K in NVIDIA and now it's worth like 500,000. I don't know. Let's see. Peace and appreciation. Can you explain the difference of reinvesting dividends and capital gains? So let me just say this. I like to reinvest dividends because I want the compound interest of all of it. I don't need that little $300 a quarter, that little $1,000, $1,200, $15 every few. I don't need that. I want you to go ahead and throw that back in there, right? And so that compounds too. So it's all I want it all to compound until I get ready to use it. So that's one of the reasons I decided to go ahead and make sure I reinvest my dividends always, even on my single stocks. I have a small single stock portfolio, but I'll also reinvest those dividends as well. Let's see this. Yeah. Listen, this is why I say somebody said this presentation should be required viewing for all beginning investors. You need to share this video with somebody who you know who's interested in investing. Just when this is over, copy the link, shoot it out to your Facebook group, to your best friends, or your children, or your grandparents, or whoever's looking to invest or start investing. This is important information because it demystifies ETFs and index funds, and it tells you why that's the best place to start for 99% of us, right? Let's see. Somebody says, and I'm skipping a few guys, so please bear with me. I'm just getting to the ones that that are near the end. Somebody says, as a novice, is it best to invest in a few thousand in index funds and let them sit 452 10 years? I don't know what that means, but yeah, you want to get you some good ETFs and index funds. You can watch them, but you ain't got to watch them like you watch individual stocks. You don't have to be reading earnings reports and those type of things, right? So yeah, get them and hold them. I'm a buy and hold person. Is it okay to move from S&P ETF to silver ETFs? If it fits in your overall long-term plan, yes. If it doesn't fit in your overall long-term plan, don't. Again, it depends on what your goal is, what you're trying to do, how much of your money. If you got $1 million in your S&P 500 ETF, and then you want to move 30,000 over into silver, cool, right? But if you got $1 million in your S&P 500 ETF and you want to move 700,000 over to silver, I would say you might want to rethink that. Okay. Oh, okay. They redid it. As a novice, is it best to invest a few thousand index funds and let them sit for 5 to 10 years? Yes, but you need to look at them every now and then. There's nothing wrong with doing that if that is your preference. But you do want to check them every now and then, see where you are. Let's see here. Dollar cost average into index funds and ETFs. Put small amounts in that. You can afford to invest. I like that idea. Dollar cost average. Don't try to time the market. I don't know if you guys know this stat, but there's several studies, but over a 20-year period, any 20-year period in the stock market, if you miss the top 10 days in the S&P 500 over a 20-year span, if you're not in the market because you're trying to time it, jumping in and out, your portfolio can decrease by up to half after 20 years, just because you missed the 10 top days. So please don't time the market. Stay in the market. Patience is the key, as someone said, right? Let's see here. Empower used to be my Works 401k. Haven't used Empower. Don't know anything about it. Somebody said Fidelity is good. I like Fidelity. It's cool. It's very easy to use. Yeah, when you need the money, long-term investor versus short-term, when's your retirement, all that stuff is super important. I'm 32 and I already decided that buying additional single stocks has now ended, but I don't sell any of the single stocks I have. Nothing wrong with that. You got a few of them that you want to hold on to. What you could do is all future money, reallocate how you're actually investing your future money. So that, yeah, you keep your positions you have in your current single stocks, just make sure everything else, now you're building out a more balanced portfolio with more balanced allocations. So everything is not NVIDIA and Taiwan Semi and Broadcom, but now you bring in some, some Waste Management, some Colgate Palmolive, and some Coca-Cola, some Costco, some other things that are more value oriented to balance that thing out. If you're 32, that would be a good suggestion. Let's see here. Thank you so much. I listen to you all the time and have learned so much. My pleasure. My pleasure. I'm glad I could help. All I have is ETFs. Got it at the end of 2021. Lots of gains. Yes. If you've been investing since 2021, 2022 was a rough year. I think 2022, the S&P 500 was down, but guess what? 2023, up 20 something percent. 2024, up 20 something percent. 2025, up 17%. 2026 won't be up that much. That's my opinion. So just understand that this thing is an ebb and flow, right? Is it wise to invest in silver now? Maybe. And I don't want to frustrate you with my answer, but I say maybe because what is your goals? What does the rest of your portfolio look like? When do you plan to need the money? What is your overall diversification? How old are you? Right? These are questions that matter to answer your question. Is it wise to invest in silver? What is your risk tolerance? Right? So all those questions have to be answered in order to figure out, is it wise for you to invest in silver right now? Right? So what happens sometimes on YouTube is people answer your questions as if they know everything about you, and they don't. Right? This is why I challenge you to know everything about yourself so you can answer that question for you. Right? So somebody said, I would say diversification is good, but to each their own. I've heard some people say, don't diversify. I like diversification because I want to kind of spread my risk and keep my risk lower, but I'm a more conservative investor too, right? Let's see here. Expectation for silver is $150 to $300 per ounce. Wow. That would be amazing if that happened. We'll see what happens. Let's see. Somebody said, question, can you discuss rebalancing and give a guideline for different ages from retirement? Man, you're looking for me to go deep with that question. Rebalancing just says this, just so you know. If you say to yourself, I want to have an 80-20 split in my overall portfolio. I want 80% of my money to be in index funds, and I want 20% of my money to be in bonds. 80% in index funds, 20% in bonds. Well, over the course of investing throughout the year, the ETFs do well. The bonds don't do as well. Next thing you know, at the end of the year, you look at the actual portfolio you have, and now you have 93% ETFs and only 7% bonds. So you want to take some of the ETFs and move them into bonds so you can go back to your 80-20 split. That's all rebalancing is. Once a year, twice a year, once a year is plenty. Once a year, you rebalance to whatever you wanted your portfolio to be at. And that's really the gist. I think I said that right. Gist of rebalancing. Okay. And in terms of different ages, it just depends. Now, allocation can change at different ages. Here's what the rule of thumb is. The closer you get to needing the money, you may want to have a little bit of less volatility, right? So instead of being 80% ETFs and 20% bonds, if you're 65 years old and you're about ready to retire, maybe you want to be 60% ETFs and 40% bonds. I don't know if I'm answering your question, but that's sort of what happens in terms of age. Appreciate your channel. Thank you so much, Patrick. Don't chase the money. Never chase money, right? Chase value. It'll get you a lot farther, and it'll make you more money and give you more resilience and give you more discipline and give you more patience. If you chase value, don't chase money. Thank you. I'm glad I posed those questions. I'm 39. Okay, I'm just reading a few others, guys. How much should you allocate in ETF index funds before getting exposure to individual stocks? That question depends on a lot of factors. When do you want the money? How old are you? What is your risk tolerance? What do you know about individual stocks? Are you prepared to learn so you can make good choices? What I do and what we're going to be talking about in this 30-day money reset that we're having in February, one of the things we're going to be talking about is developing a plan for investing. What are your core beliefs about investing, right? About investing. What What do you think about businesses? What do you think about finding companies with moats and competitive advantages? We're going to be spending a live session as part of that it's going to be 3 live sessions, and it's going to be access to my full course, right? I got a full course that's 4 hours of instruction with 120 different reflection questions with, you know, 16 different handouts that are fillable. You get access to the course and you get free lives. You're going to have 3 of them. One of those is going to be about how to develop a strategy for investing. So this is why I'm saying that's coming, and I'm going to be announcing a lot more about that in about a week or so. So that may be something that if you really want to go deeper, we're going to go much deeper in the month of February, and really try to get people to understand the importance of figuring out their own strategy. Right. So you're not developing your strategy based on my thoughts, but you're developing your strategy based on your thoughts. Right. That's a big shift for a lot of people. Let's see here. Yes. Oh, Mrs. Moore is in here. Appreciate you, Mrs. Moore. Thank you so much for being here. I got to give Mrs. Moore a shout out. She's been sort of my person that has helped man or woman or man person the chat for me. So thank you so much, Mrs. Moore, for being here. Guys, I haven't said it this whole time, but you got to hit the thumbs up button for me. The very least you can do is hit the thumbs up button for me. So thank you for pointing that out, Mrs. Moore. Please hit the thumbs up. Somebody said earlier, a couple folks said, this is something that every beginner needs to see. You're 100% right. But this is something that YouTube needs to kick out to them. And it only kicks it out if you hit the thumbs up, if you make sure that you share the video. That's how it gets seen, right? Let's see here. Question: any thoughts on not auto reinvesting the dividend and rather putting? I'm not sure what you're saying, but if you don't reinvest the dividends, no big deal. I'm not mad at you. I just like to do it, right? Because I want everything. Thank you for all you do. Appreciate you guys. Listen, I'm not going to hold you. If this helped you better understand how ETFs and index funds actually work and why starting a foundation matters with ETFs and index as your foundation matters more than individual stocks, then this live did its job, right? Again, for those of you who want to go deeper onto this mindset thing, into thinking and managing, check out my book, Manage Your Way to Millions. You can go to manageyourwaytomillions.com. It expands on everything we talked about, not just tonight, but everything you see in my videos, step by step. If you want something practical, again, there's a free Debt Snowball Worksheet in the description box on YouTube. Check that out. It'll help you get organized and start taking action immediately with changing your financial situation. No pressure. No pressure to buy anything from me. These are just tools that are available. So you understand, I'm not just giving you information on YouTube. You can go a little further with this stuff, right? So grab whichever one of those things fits you. As soon as you get off this, you can grab them. And you can drop questions in the comments section on YouTube. And I usually answer as many as possible, right? So with that said, guys, this was supposed to be a 1 hour or less, and it's 1 hour and 20 minutes. But guess what? We was having fun. Listen, I want to thank you guys so much for being here. I hope I was able to explain ETFs and index funds and answer some of your questions on why ETFs and index funds actually work for most investors, right? My hope is that you got value out of being here tonight. That's my biggest hope, right? Drop a comment, share the video with someone who you want to help or who you want to introduce into investing. And as I always say, guys, I thank you so much. Watch the rewatch, right? As I always say at the end of every video, again, thank you, Mrs. Moore, for being here, and thank all of you for being here as well. The absolute best person who's going to take care of the old you, not your kids, not your grandkids. It's not even the nursing home. We know it's not the nursing home. It's not whoever's the president. It's not your local city council member, right? No, it's none of that. The best person who's going to take care of the old you is the young you. the you are today. Take care of yourself and take care of other people. Until the next video, peace.